What's up, YouTube? It's the Action Figure Grader coming back to you with kind of a general discussion video. And I would encourage you guys to share your thoughts on this and what your opinions are. And some of you guys may not have an opinion or care at all about this topic. But I do think that there are warning signs that, at least in the US, we're headed for a pretty major recession. I think you can argue that the same is the case over in Europe, given everything that's going on over there. And there's a number of reasons why. And one of the big worries is the idea of stagflation. Stagflation. And so if you guys are into economics, you guys probably already know about what that means. But if not, I'm going to kind of give you a general idea of it. And the warning signs are there for the global economy for us to be entering a period of quote-unquote stagflation. So what is stagflation? Stagflation is basically, it describes an economy with little or no growth and then also higher than normal inflation. Usually those two kind of go opposites, right? When you have recession, prices tend to decrease because businesses are strapped for cash and they want to kind of keep in business. But right now we're experiencing major inflation in the US, historic inflation, higher than it's ever been in 40 years. You combine that with the potential for an economic downturn due to kind of some of the events that are out there right now. And it's worrisome. So stagflation is basically just inflation combined with a stagnant economy. So stagflation, unemployment and inflation typically move in opposite directions, since price levels are usually driven by the economy's level of demand. So right now, I think we're kind of in a weird spot, right? We've had so much pent-up demand over the last year and a half, 2 years, because of everything that happened with coronavirus. And now we're kind of entering back into a growth phase, right? People have all this money to spend. Things are opening back up. So inflation is a big driver. But there has been periods of kind of stagflation in the past. And most notably, that would be in the 1970s when Richard Nixon took the U.S. off of the gold standard. That was kind of a big deal because it set the stage for a decline in the value of the U.S. dollar. And as a result, inflation kind of went through the roof. But the bigger factor that I think contributed to a period of kind of stagflation was OPEC. And that's where I think current events right now are headed, because we have major issues going on over in Eastern Europe, and the global oil supply is being disrupted because of stuff that's going on with the Ukraine. And back in the 1970s, OPEC placed an oil embargo on certain nations that they viewed as supporting Israel. Well, obviously the U.S. was one of those nations. And as a result, we had massive price increases, and we also had big unemployment, and we also had a pretty major period of recession. Interest rates, by the way, peaked out in the 1980s, in the early 1980s, in the 20s. 22% used to be your annual kind of interest rate. And I very vividly remember, my parents paying like 18 or 19% interest rate annually just for a mortgage for their house. I mean, that's just crazy when you think about it nowadays, where interest rates are closer to 3 or 4%. Well, why has it been revived? Well, we got prices that are rising rapidly, and we're going to talk more about that in a second. We've had kind of things that have undermined growth related to the coronavirus. It's held back a lot of different industries in the U.S., and it's made for a weaker recovery. But prices have still been jumping because of supply chain disruptions, and now oil prices are jumping through the roof. So it's the highest inflation numbers we've seen in a while. Wages are increasing, but purchasing power is not. Purchasing power is not, and that's a big concern, because it means that more and more of our income is going towards basic necessities like food, rent, or mortgages, housing costs, utilities, groceries, and it's a big deal. And now with Russia invading the Ukraine, oil prices are way up, and they're kind of all over the map right now. They just dropped back again down today, and we're going to talk more about that. And it's just created a lot of uncertainty. And, so we've already talked about in a number of different videos about inflation and the fact that the surging prices of everything spells stagflation risk. This is another article and I'll put a link to all these articles if you want to take a look at it. One of the other big ones is metal prices. Metals like nickel go into a number of different components that, items that we buy and make, computer chips, whatever else. And one of the leading exporters of nickel is Russia. And as a result, that market has been badly disrupted. Oil, the price per oil, I'll show you that real quickly. Look at what the price of oil has done. Monday, February 28th, it was sitting at about 95 bucks a barrel. And then everything happened over in Eastern Europe. It got as high as $123 a barrel. So that's a huge jump just in a few days from 95 to 123. Now it's since come back down to 94, 96 $96 as of this morning. But there's a number of different economists that are saying, the oil disruption because of what's happening over in Eastern Europe right now, it's going to drive oil further. And what's going to happen in Europe is the big deal, because Europe gets a vast majority, or maybe not a majority, but a significant percentage of the oil consumed by Europe, by Western Europe, comes from Russia. And with all of the banning of doing business with Russia because of what they did in terms of the invasion of the Ukraine, there is absolutely risk that that Western Europe goes into a major recession, and very soon. And it's, because the economies nowadays are so globally intertwined, that I find it really fascinating that we're not talking more about what's going to happen to the U.S. economy. So goes Western Europe. I got to believe that to a certain extent, so goes the U.S. I know we have a lot of domestic consumption. We have a big country. We have a big population of 300 plus million. But, the economies nowadays are so globally intertwined that I just got to believe that we're going to be seeing the major risk for a recession here in the U.S. as well. And this just came out March 10th. Prices climbed at the fastest pace in decades in the month leading up to the war in the Ukraine. And the Consumer Price Index, which is kind of a nice measure of different goods and services within the U.S., that rose by 7.9% in February. That's the fastest pace in 40 years. So, rising food and rent costs contributed to the biggest increase. So what does that mean? That means that our purchasing power may be flat or down, even though wages are rising right now in the U.S. We're in a high inflation environment, but our purchasing power is decreasing because of the basic necessities that we need. And I think that, the Fed is finally recognizing the fact that we're in a high inflation environment. So typically, historically, at least over the last 20 or 30 years, what the Fed has done is, well, in order to keep inflation at bay, they've raised the federal funds rate, the lending rate, and that raises the cost of capital for all these businesses. Well, the problem now is we're in a high inflation environment, and if the Fed decides to put the damper on inflation by increasing the cost of capital, what's going to result is we're going to have a slowdown in the economy. So that's where the idea of stagflation comes into place, because the Fed is going to have to do something to keep this inflation in check. It's just out of control right now. It's the highest in 40 years. The only major tool, they have smaller tools, but their biggest kind of hammer in the toolbox is to change the lending rate through increasing the cost of capital. So that typically slows down the economy. Well, if we have a slowing economy combined with higher interest rates and still high inflation, it's going to lead to a period of stagflation. And we'll see if it happens or not. But as you can see, the market is just so confused right now, especially within the oil market, as to what to do. March 8th, it was trading at 123. March 15th is trading at $96 a barrel. Think about that. That's like a 25 or 30% drop in a week. So clearly the market doesn't know what's going to happen with the world oil supply. And as goes oil, as goes our economies, both in Europe as well as, overseas. But, looking at Russia and what their exports are, their major exports are just what we talked about. Their top export is crude petroleum, 123 billion a year. Refined petroleum, another 66. So about, let's call it $190 billion US dollars worth of oil and petroleum are their exports annually. That's a big number. Petroleum gas is another 26 billion. Coal briquettes. And then the other big one that we're not talking about, Russia is one of the largest suppliers for food for the world right now. $8.14 billion of wheat is a really big number. But if you look at what the major countries that buy Russian exports, obviously China is really close with them, so they take a pretty significant portion of their exports. But the reason I bring up Europe and the increasing likelihood that Europe is going to be experiencing a recession, the Netherlands, Belarus, Germany, Italy, those are all countries in Europe, either in Eastern Europe or in Western Europe, where a vast majority of the oil consumed by those countries comes from Russia. And I think that you need to start thinking about that. The other big thing that I just mentioned is Russia is the world's biggest exporter of wheat, so food costs could go up further the less that these other countries ban doing business with Russia. They are also the largest supplier of semi-finished iron and raw nickel. Again, both of those go into computer chips, go into the manufacture of different technologies here in the U.S. And so it's a concern, because while Russia economically is not a major player, obviously geographically they're huge, but from a world economy standpoint, they're not. The problem is the items that they do export are very important, and they are the largest exporter of those items. So it's a concern that as those prices for food, especially, and for metals, as those increase in price because of countries banning doing business with Russia, it's going to lead to even higher inflation than we've already experienced. What's interesting is that Goldman Sachs does like a forecast, and they're saying that the chances of a U.S. recession, the odds of that are now at 35%. So about a 1 in 3 chance that the U.S. experiences a recession soon, due to everything that's going on between the high inflation, supply chain issues, and now with what's going on over in Eastern Europe. And CNBC confirmed that. They did a survey of different experts, and they all had about the same number, 33% chance of the U.S. hitting a recession. So I think those numbers are low, personally. What do I know, though? These guys are way smarter than I am. But I think that the chances of the U.S. going into a recession, the longer this war goes on without some kind of peaceful resolution, the higher the chances that the U.S. gets into a recession. And I put it more like 1 in 2 chance. I don't see an easy resolution. No one's backing down. The U.S. and all these other countries in Western Europe are all backing away from doing business with Russia. It's going to continue to cause supply chain issues in a high inflation environment. So, and one thing I wanted to talk about is the stock market, right? The stock market historically, if you subscribe to efficient market theory, the stock market is a predictor of what is going to happen. And if you look at the S&P 500 year to date, even, which dates obviously before what happened in Eastern Europe and the invasion of Ukraine, the market was already kind of tanking. And so, at a max, it was kind of in January that hit up, for the S&P 500, it was at 4793. Let's call it 4800 for the S&P. And now we're down to about 4200. So that's about a 50, let's call it a 10 to 15% drop. Typically, a bear market is around a 20% drop from highs. So we're getting close to that number. We're not there yet, but I think that, if you believe in the theory of efficient markets and the fact that the stock market typically predicts what's going to happen, usually by the time we have a recession, the stock market's already priced it in and it's already dropped 20% or more. We're getting close to that number, though. So I do think that, me personally, I think that we're overdue for a recession just with all the growth we've had. But the problem is the high inflation environment that we've had. The Fed is going to have to raise rates here soon. And as a result, I think that we could see a recession sooner rather than later. I hope I'm wrong. But will that affect collectibles prices? To kind of tie it back to my channel, who knows? But I think that given everything that we've seen in the Star Wars collectibles market, both modern and vintage, I'm not sure if a recession is necessarily going to affect it, because those that collect and spend the kind of money on those collectibles, they might be quote unquote recession proof. and they're not as affected by it as, you know, the average day-to-day Joe who is just trying to make ends meet. So it'll probably, if I had to guess, it'll probably have some sort of effect, but probably not nearly as strong or as rapid as of an effect on collectibles prices as what we're seeing kind of in the stock market and with oil prices and everything else. That's all I really had for this video. Let me know your thoughts. Thanks so much for watching, and I'll be back soon.